Wall Street operates on a discrete clock. The closing bell rings, the ticker stops, and liquidity freezes until morning. But the decentralized financial system never closes. It generates blocks, clears trades, and settles value continuously, 24 hours a day, 7 days a week. This continuous execution environment is actively absorbing traditional finance. By early 2026, the global asset tokenization market reached $1.75 trillion, establishing a mathematical trajectory to hit nearly $24.5 trillion by 2033. Within that massive total addressable market, tokenized equities operate as the primary growth engine. They are pulling in retail demand and heavy institutional capital formation, displacing isolated, speculative cryptocurrency experiments. Entering the second quarter of 2026, a specific macroeconomic shift accelerated this demand. The U.S. Federal Reserve's rate-cutting cycle stabilized systemic liquidity, reigniting institutional appetite for high-duration growth assets. But a declining rate environment also compresses the net interest margins that traditional banks rely on. To defend their profitability, these commercial and investment institutions are forced to hunt for new, fee-based revenue streams. Tokenized asset infrastructure provides exactly that. By overhauling their legacy systems to offer digital custody and smart contract administration, banks unlock a highly lucrative operational vertical. Moving equities on-chain serves as a foundational systemic migration, restructuring the mechanics of how global capital settles and clears. As this infrastructure scales, the market has sharply divided into two distinct operational models: wrapped synthetic securities and natively issued equity tokens. This flowchart maps the wrapped model, which currently dominates offshore platforms. An intermediary, often an offshore trust, buys traditional corporate shares on the open market, places them in a centralized vault, and mints a fractional blockchain derivative that represents a claim on that custodian share. This introduces severe operational friction. If the intermediary faces insolvency, the investor becomes an unsecured creditor and loses their legal claim to the asset. Furthermore, these synthetic tokens trade off the consolidated tape, fracturing price discovery, and they completely sever corporate entitlements like proxy voting and dividend distributions. Because of these legal liabilities, institutional capital is pivoting aggressively to native issuance. In this model, the cryptographic token itself is the primary, legally recognized record of ownership, effectively acting as a modernized direct registration system. Native tokens embed programmable business logic directly into the asset. Routine corporate actions, like routing dividend payouts or executing proxy votes, trigger autonomously on-chain without requiring layers of traditional brokerage intermediaries. National market operators are moving to standardize this. Nasdaq's proprietary equity token design, rolling out in 2026, places the public corporation directly at the center of this issuer-sponsored ecosystem. Embedding smart contracts into the equity itself enables programmable capital efficiency, delivering functional utility while strictly preserving the investor's legal rights. Running natively tokenized equities at an institutional scale requires specialized blockchain infrastructure. It demands sub-second transaction finality, deep compliance monitoring, and seamless cross-chain interoperability. Japan's Progmat platform serves as the defining case study for this transition in early 2026. Backed by the nation's largest megabanks and the Tokyo Stock Exchange, Progmat commands a dominant share of the Asian digital asset market. To achieve global scale, Progmat is executing a massive technological migration, moving over 439 billion yen in tokenized digital securities off an isolated banking ledger. The destination for these assets is a highly scalable, application-specific public Avalanche Layer 1 network. This architecture gives financial institutions granular control. They can enforce customized validator rules, localized tokenomics, and strict Know Your Customer and anti-money laundering whitelists, all while operating on public rails. Most importantly, this migration introduces Ethereum Virtual Machine, or EVM, compatibility. The EVM is a standardized software environment that executes smart contracts, meaning these Japanese equities can now interact seamlessly with global decentralized finance protocols and Web3 wallets. This diagram illustrates how developers are deploying light client proxy, or LCP, technology to prevent liquidity fragmentation. LCP generates cryptographic proofs that securely verify a transaction from a source blockchain on a destination chain, bypassing the need for vulnerable centralized bridge intermediaries. Settling these cross-chain transfers requires a reliable currency. Compliant stablecoins have become the internet's dollar, acting as the indispensable settlement layer that provides the digital cash necessary for instantaneous delivery versus payment clearing. Combining EVM-compatible networks, proxy bridging, and stablecoin liquidity creates a fully integrated, trustless financial plumbing system capable of handling trillions in institutional flow. But wiring traditional finance into decentralized networks creates a severe structural friction point. This timeline shows the traditional U.S. equity market operating on a T+1 settlement cycle, meaning a trade takes one full business day to clear. The tokenized economy operates on atomic settlement, or T+0, where the transfer of the equity and the payment occurs simultaneously within a single block validation. This asynchronous relationship forces market makers bridging the two systems into a difficult position. They must maintain complex, highly expensive capital liquidity buffers simply to manage the 24-hour delay between on-chain token availability and traditional equity clearing. Intriguing. For algorithmic traders, this temporal mismatch functions as a highly lucrative, mathematically low-risk quantitative arbitrage opportunity. Consider a weekend scenario where major geopolitical news breaks. Traditional markets are closed, and the underlying stock is frozen, but perpetual derivative contracts on decentralized exchanges continue to trade and rapidly reprice. If weekend sentiment drives an equities perpetual contract to an irrational premium, quantitative bots immediately execute a delta-neutral strategy. They purchase the tokenized spot asset on-chain while simultaneously shorting the overvalued perpetual contract on the decentralized venue. By holding both positions, the trader locks in the asset's underlying value while continuously pocketing the inflated funding fees paid by long speculators, yielding a profit entirely independent of the stock's actual price direction. Cautionary. However, executing these trades on decentralized platforms carries acute execution risks. Because these exchanges rely on fragmented liquidity pools rather than centralized limit order books, large orders suffer from severe price slippage. Traders also face maximum extractable value, or MEV. MEV occurs when the network validators who process the blockchain intentionally reorder transactions within a block, front-running retail equity orders to extract hidden profits. The friction between traditional T+1 clearing and digital T+0 atomic settlement functions as an actively traded structural feature, which sophisticated quantitative funds exploit for consistent yield. As multi-billion-dollar corporate equities rely on this blockchain infrastructure to clear, the cybersecurity of the ledger elevates from a technical IT concern to a matter of systemic global market stability. The nature of cyber threats has matured. By 2026, sophisticated attackers are rarely targeting basic cryptographic failures. Instead, they exploit complex structural and business logic flaws hidden deep within the smart contracts. The Open Worldwide Application Security Project's 2026 threat analysis ranks access control vulnerabilities as the absolute highest risk to smart contracts. Because compliant native equities must adhere to the law, their code requires administrative functions. Developers must hold keys that can pause trading, issue corporate splits, or blacklist specific wallets to enforce anti-money laundering regulations. If an attacker compromises those administrative keys through weak operational security, the consequences are catastrophic. A malicious actor could unilaterally alter a public corporation's capitalization table on-chain, erasing shareholder equity in seconds. To mitigate this, institutional issuers must enforce absolute hardware-backed key custody. They require strict geographic signer isolation, multi-tiered approval time locks, and algorithmic velocity controls on all withdrawals. Securing a tokenized equity market requires holistic, typology-driven operational hardening to defend against industrialized threat actors, reaching beyond the scope of traditional smart contract audits. The convergence of these technological, regulatory, and macroeconomic forces dictates a highly bifurcated trajectory for the first half of 2026. Analysts project acute, localized volatility driven by massive selling pressure. Over-leveraged digital asset treasuries are showing severe signs of distress and are expected to execute forced liquidations of their speculative tokens to cover outstanding debts. Yet, tokenized traditional equities are mathematically shielded from this crypto-native liquidation cascade. Institutional capital values their resilient corporate cash flows, defensive margins, and established legal governance. This separation of true assets from speculative tokens is anchored by the U.S. Securities and Exchange Commission's strict substance over form doctrine. The legal reality is absolute. Taking a security and placing it on a blockchain network does not relieve the issuer, sponsor, or intermediary of their regulatory offering registration, exemption, or rigorous disclosure obligations. For capital allocators and infrastructure providers, the strategic imperative is clear. Liquidity must now rotate out of speculative accumulation and aggressively target permissioned, compliance-first protocols offering yield-bearing real-world assets. Establishing enduring dominance in the coming decade requires the systematic exploitation of the T+0 temporal paradox, while fully embracing the legal rigors of native, issuer-centric tokenization.